So that's what we're going to set right now. So what this is saying is, well, if if the stock, right, expires at the first expiration, if the stock is at the strike. So what if the stock does, because our best case scenario is that first expiration, like in NVIDIA, the stock settles right at 140. Right. So that's where our sweet spot is as far as the stock price goes. Because at 140, the first expiration that we sold expires worthless. And then the expiration that we're long, the further term, well, that option will be all time premium, right? So that's where the time premium is the largest, because that option, it's all time premium, right? It's not out of the money. So we'll have less time premium. If it's in the money, it has intrinsic value, but it's all time premium right at the money. That's where it's the greatest. So if, let's say that we do reach that scenario and the stock is at 140, right? We want a minimum return, but it also depends on where the implied volatility is, right? So if the implied volatility is higher, then that option that remains will be worth more. If the implied volatility is lower, the option will be worth less. So you could see here, look at this payout. If the option, we're assuming that the near-term option, November 15th, that expiration will be worthless because it's right at the strike. Well, then our strategy is based on what the option we're long is worth, right? Is it worth more than we paid? So if we're paying 610 for the original strategy, it's got to be worth more than 610, right? The option remaining, or we're a loser. So here, it gives us different scenarios.